Today there is a clear impact of the tax treatment which derives from the France-Luxembourg tax treaty. This treaty is supposed to be amended by year end and it will end up with the taxation of French real estate companies sold by Luxembourg investors. Around the past few years, you have seen a lot of investors coming into France through Luxembourg. So this has a direct impact, in fact, on existing investment structures. So a lot of investors are, in a sense, forced or invited to sell their assets by year end in order to, in fact, reinvent the right structure to own their assets. So today it's a key driver of the market. We see two kinds of investors: those who want to keep the assets on balance sheet and they are restructuring their ownership structure using, for instance, OPCI, which is French closed-end fund, as a way to mitigate the impact of the change in the tax treaty, or other investors which are in fact selling their assets and in a sense giving the opportunity to new investors to set up a tax-efficient tax structure. So this is clearly today one of the key drivers by year end. What is also important is that we have now a lot of thoughts about the way we shall structure future investments, and there are some debates. OPCI is seen as a good way of mitigating the tax treatment, but other alternative structure may be also of interest. And then it is also interesting because it favors some assets such as hospitality assets, because they would not fall under the definition of mainly property company, which are taxable under the tax treaty with Luxembourg. So obviously speaking, we have very strong drivers coming from this tax treaty.